Hi, Business 202. This pre-recorded Google Hangout introduces you to managerial accounting concepts, and it represents a break between the financial part of Accounting 1 and the managerial part of Accounting 1. The purpose of today's Google Hangout is to emphasize two main points that Chapter 18 tries to get across. Number one, how accountants fit into the managerial decision-making process. And number two, the additional chart of accounts that are necessary to account for a manufacturer's operations. Okay, so let's see how this works. First of all, managerial accounting. It's internal use only information. Unlike financial accounting, which has the purpose of showing information to the public and is governed by generally accepted accounting principles and watched by government agencies and other watchdog staffs, managerial accounting is strictly internal use only. As a matter of fact, it's proprietary. And if employees within an organization would disclose this to the public, they would be in trouble of essentially stealing proprietary or private information. A second distinction between financial accounting, which is public, and managerial accounting, which is private use only, is that generally accepted accounting principles are governed by rules and regulations that must be adhered to protect the public. Managerial accounting, on the other hand, exists solely for the decision makers within an organization. The information that managerial accountants provide is to make the decisions that certain areas and certain managers within an organization better. Okay, so let's focus on what a business does, and let's turn our attention to the process of what goes on in a particular company's decision-making year. And let me just blow this item up a little bit. This is an Exhibit 3 from page 837 of your textbooks, and it represents what management does. Now, depending on the textbook that you read in management, there may be between 4 and 6 different elements that describes what management does. But essentially, here's what your textbook is saying. At the beginning of the year, the business plans its operations. This is most often evidenced by a budget that represents the resources, the personnel, and the financing necessary to carry out business operations. Managerial accounting affects the planning phase, and we will get to that in chapters 21 and 22. During the year, management is charged with making decisions. Two types of decisions that they make during the year. Number one are decisions to direct the activity of the organization. The people, the resources like the plant, property, and equipment, and the location where plant, property, and equipment might be, and also for arranging the financing that the company needs to pay the employees and to make sure the resources run effectively. A second set of decisions that management makes is, after reviewing the year's process, well, how can they improve the process for the coming year? That is also known as the control function. What happens at the end of the year is that the actual results for the company is compared to the plan that was made at the beginning of the year. And some decisions are made about, well, did the company perform as planned? Did it perform worse than, or did it perform better than planned? If it performed better than it planned, well, the company wants to repeat that to improve performance in the coming year. If the company did not work according to plan, Well, what changes could be made so that in the coming year, operations can be more effective? Okay, here's a tie-in between your course here in Business 202 and what you've taken in Business 120, Introduction to Business, and what you most likely are taking now, Business 300, which is Organizational Management. And that link is how information ties to people on the organization chart. So what I'm going to show you now is Exhibit 2 on page 836. And what Exhibit 2 is illustrating are the decision makers within an organization. And it just happens to be for the Callaway Golf Company. And it shows the president who is in charge for the strategic plan of the company, a vice president of administration, a vice president of brands, a vice president of equipment, and the CFO, the chief financial officer. These individuals make decisions about the resources, the personnel, and financing of the operation. And these individuals are known to have what's called line authority. They can hire, they can fire, they can move resources. So they are very powerful people within an organization, and their posts demand that they have good information so that they can make these types of critical decisions. Where does that information come from? Well, you might have guessed, it comes from the accounting department. The accounting department represents the information system that feeds the information and data to these people who make decisions so that they can make better decisions. The managerial accounting department is known as a staff department because it gives advice. It doesn't make the decision, but it creates the information that allows the decision makers to make the decisions. And so the type of information that the managerial accounting folks generate is that information that's necessary for the decision makers to make appropriate decisions. Let me say that again. The main guiding principle for the information that the managerial accountants give is that it's that information that allows the decision makers to make better decisions. There is no generally accepted accounting principle that dictates a certain type of information is necessary. It doesn't say when or how often this information goes to the decision makers. It's up to the decision makers to determine what information is necessary, and then it is up to the managerial accounting department to deliver that information when the decision maker wants it. Okay, all right, so that's part one. That links the managerial decision makers to the managerial accounting department. The second item that this chapter does is to show some of the additional accounts that are necessary for a manufacturer. If we remember way back to Accounting 1, Chapter 1 indicated that there are three types of business entities. One would be a sole proprietorship, two would be a partnership, and three would be a corporation. And as we move from proprietorship to partnership to corporation, complexity increases. The same type of relationship happens here as we move from different types of organizations, from a service organization to a retailer to now a manufacturer. The complexity of the operation increases because there is just more stuff that needs to be done. For example, a service organization just needs to have enough personnel to carry out the service. And for the service organization to make money, it must repeat that service as often as customers want it. It can't store the service. It can't do anything but repeat the service in order to make more income. For a retailer, the retailer adds the complexity of inventory. So it needs a place to store and make sure that inventory is kept current so that customers can come into their place of business, buy the inventory to make the retailer's income. Now, the retailer has a fairly simple operation because it buys its inventory from various manufacturers. Now, what about those manufacturers themselves? That's what we're talking about right here. The manufacturer must start with some basic raw materials, add some skilled people to work on those raw materials to make the finished product. So the manufacturer's operation is significantly more complex because it has inventory and people to work on that inventory. So let's just take a look at Katrina's Trinkets, which is an example of a document called the cost of goods manufactured. Now, just to put this into perspective, the cost of goods manufactured for a retailer is comparable, the cost of goods manufactured for a manufacturer is comparable to a retailer's purchases. A retailer has a simple operation. It buys stuff, it displays stuff, and allows customers to buy stuff. A manufacturer must buy raw materials, it must get skilled people to work on those raw materials, and it must transform those raw materials into the finished product. Okay, so it will have three types of inventories. One would be the direct materials inventory, which represents the raw stuff that must be converted into the finished product. The second type of inventory that the manufacturer will have is something called work in process. That represents raw materials that have been worked on but have not yet been completed. Work in process represents partially completed inventory. And the third type of inventory that manufacturers have, which would be very comparable to the retailer, would be finished goods, the stuff that's ready to be moved from the manufacturer's plant to the retailer's shelves. Okay, so let's see how these chart of accounts relate to the cost of goods manufactured. And here is what we will show you. The cost of goods manufactured statement, which is a formal display, shows the activity in this new account called work in process. Work in process is the main inventory for a manufacturer and shows what is unfinished at the beginning of the period, the additional costs for material, labor, and overhead to transform the raw materials into the finished goods, and what's left over unfinished at the end of the period. Here's a key. The amount that's transferred out of work in process is the CGM, or the cost of goods manufactured, which is comparable to the retailer's purchase. The amount transferred out of work in process becomes the increase in finished goods that the manufacturer can ship out to the retailer. When the manufacturer ships those goods to the retailer, it reduces the finished goods, and that becomes the cost of goods sold for the manufacturer. Okay, that's a general rundown. Let's look at some of the detailed values that this particular exhibit displays. In the beginning of the year, the manufacturer, Katrina's Trinkets, has $135,000 of raw materials. That would be evidenced in this inventory account called raw materials or direct materials. And the B that you see in the outline represents balance. So the balance at the beginning of the period on January 1 would be $135,000. Now, to support the manufacturing operations during the year, Katrina's Trinkets bought $620,000 of more raw materials, string, beads, glue, all those things necessary to make the trinkets. There would be a debit increase to raw materials, and there would be a credit of $620,000 to accounts payable or cash, representing the resources that the Katrina Trinkets commits to buying the additional raw materials. The beginning raw materials plus the raw materials added gives the raw materials that would be available that Katrina Trinkets could use during the manufacturing process. Now, during the year, the managers of Katrina Trinkets draws down on some of these $755,000 of raw materials, and at the end of the year, only $160,000 of raw materials would be left. So this $160,000 would be the balance in the direct materials account. Note the B here, which represents balance at the end of the year, is $160,000. The difference between the high water mark, the raw materials available, and the ending balance of $160,000 must be the direct materials that have been moved from the stores to the plant floor as part of the manufacturing process. So the difference between 755 and 160 is 595,000, and that represents the raw materials that would be consumed in the manufacturing process and would represent an increase or debit to the work in progress account. And that is also shown to you in the cost of goods manufactured statement as this raw materials transferred to production. Now, this raw material needs skilled labor to transform the raw material into the finished product. And so the second item that would add to work in process would be the wages and salaries of the production personnel. And in the case of Katrina's Trinkets, that's $405,000. So there would be an increase in work in process, and the credit would go to wages and salaries payable. Just as a note, the direct materials and the direct labor are known as direct cost because these are the costs that are easily and directly traceable to the final product. We know how many beads or how many yards of string would be consumed in making however many trinkets that Katrina Trinkets made during the year. And we can easily track the number of hours that production personnel worked to make those trinkets during the year. Now, that brings us to the third type of cost in the manufacturing process, and that is factory overhead. Factory overhead represents all those other costs outside of direct materials and direct labor that are necessary to make the plant run. And there is a variety. Indirect materials like grease for the machines, cleaning supplies for the shop floor. There would be items like indirect labor, which would be supervisory or inspection cost. There would be the heat, light, and power for the factory, which represents the utilities to make it run. Also communications, cell phones, and so forth would be there. There would be depreciation on the factory equipment and the factory building. And there would be insurance, maintenance, and taxes on the factory resources themselves. Additionally, there could be a laundry list of other items that could be specific to the type of manufacture that you have. In short, factory overhead represents all other factory costs exclusive of the direct costs of direct materials and direct labor. For this business, the sum of all the other manufacturing costs that are not materials and are not labor would be $200,000. That $200,000 would be tracked in an account called manufacturing overhead, and then that balance in manufacturing overhead would be transferred to the manufacturing work in progress account. So here's the deal. Beginning work in process plus costs added, material, labor, and overhead, give the total manufacturing cost that a manager must account for. The manager must account for what was in the process at the beginning of the period, and then the manager must account for those costs that were added during the period. Now, A certain amount of these costs represents goods that have been completely manufactured and finished and ready to be transferred to the retailer's stores. That is known as the cost of goods manufactured. So the cost of goods manufactured, $1 million in this case, would be the reduction or credit in the work in process account, and it would be the increase or debit to the finished goods account. The difference between the total manufacturing costs that a manager must account for during the year and the amount that would be transferred to finished goods, which is a way to partially account for the total manufacturing costs, 1.425 million less 1 million, means that the manager has accounted for the remaining amount of costs as work in process at the end of the period that is unfinished, but will be finished in a future accounting period. Okay, now let's examine the finished goods account. The finished goods account began its balance at the beginning of the year with $250,000 of goods. The manufacturing process added $1 million of costs, so the manufacturer had a total of $1.25 million that would be available for sale to the retailers. During this particular year, Katrina Trinkets moved $1.1 million of finished goods into the retailer's hands. So the finished goods account would be decreased or credited, and the manufacturer's cost of goods sold account would be increased or debited. This $1.1 million decrease in finished goods or increase in cost of goods sold would leave $1.25 million less $1.1 million, $150,000 of finished goods that would be available for the manufacturer to sell in a future year. Okay, that's it for this particular chapter. It merely represents an introduction to how managerial accounting fits in the business operations. Essentially, managerial accounting supplies the customized information that decision makers need to make their decisions. And secondly, it introduces you to the manufacturing accounts that manufacturers in general use to track manufacturing costs. Direct materials and direct labor and manufacturing overhead together are known as product costs, and these costs would be inventoried or spend some time in this account work in process before they are expensed on the income statement as cost of goods sold. Direct material and direct labor together are known as direct costs because they can be directly traced to the final product. And direct labor and factory overhead together are known as conversion costs because you need people and you need the costs of machinery and the factory building to convert the raw material to the finished goods. That's it. Watch the videos that you see on your course calendar describing the detail of what is a product cost and what is a period cost, and watch the videos on the detail for the movement of costs through the manufacturer's accounts to work the short problems at the end of chapter 17 or chapter 18. And as always, if you have questions, don't hesitate to email me. Give them a shot. Thank you.